Stop diversifying. It is the most controversial advice in the history of finance. We were told to never put our eggs in one basket. We were told diversification is the only free lunch on Wall Street. But the most successful investor of all time disagrees. He calls diversification protection against ignorance, a shield for those who don't know what they're doing. Today on Alpha Thought, we are not studying Warren Buffett. We are removing our assumptions to become him. And to do that, we must dismantle the 3 biggest lies you've been told about money. Forget that you are a spectator. Imagine a cold morning in 1965, a worn wooden desk in Omaha, no glowing screens, no feeds, no noise, only an annual report and the ticking of a clock. In the next moment, I will no longer be your narrator. I will become his voice. I will filter the noise with his mind. Are you ready? Let us enter the mind of the oracle.
I have always found Wall Street amusing and often, frankly, appalling. They have a talent for making the simplest, most fundamental economic truths complicated, for disguising paralyzing fear as tactical sophistication. The very first piece of advice I received when starting out, the one hammered into every single novice investor, was universal, delivered with a smug, knowing certainty. Warren, you must diversify. Never put all your eggs in one basket. I looked at that advice and I thought, this is perhaps the most foolish, most cowardly, and most financially destructive piece of wisdom I have ever heard. It is a philosophy for the intellectually timid. Let's analyze the logic. If you have done the deep, patient, and painful work to be absolutely certain that one particular basket holds a bar of pure, guaranteed gold, why on earth would you go out and buy 9 other baskets filled with straw, rotten eggs, and dust just to spread the risk? The moment you diversify, you introduce 9 new ways to fail. You ensure that the sheer brilliance and compounding power of your best idea is immediately diluted and dragged down by the mediocrity and potential failure of everything else. Diversification is a protection against ignorance. It is a strategy designed solely for those who lack the confidence, the intellectual rigor, or the patience to truly know what they are doing. And because it is a guarantee against extreme success, it guarantees you nothing more than flat, dismal, and taxable mediocrity. If you do know what you are doing, diversification is not a shield, it is an anchor. It hinders your returns. You are paying a heavy opportunity cost for intellectual laziness. Let me take you back to the height of the panic in 1964, during the salad oil scandal. American Express, due to its dealings with the implicated company, faced potential liabilities of up to $150 million, a crushing sum at the time. The stock price collapsed, dropping over 50% in a matter of weeks. The air was thick with financial despair. Wall Street was in a frenzy, screaming, "Sell, the liability is ruinous, the franchise is ruined, the public trust is broken." The fundamental error in their collective analysis was that they focused on the accounting noise, the short-term, one-time liability, and utterly ignored the enduring reality of the business. The core of American Express is not its quarterly earnings statement. It is trust, the quiet, ingrained habit of millions of merchants and consumers. I didn't consult a financial model. I didn't look at the stock ticker. I did what any true owner would do. I went into the field. I personally visited countless restaurants and stores, observing human behavior. I asked the waiters, the cashiers, the customers, "Are you planning to stop using your American Express card?" The answer was a consistent, resounding no. The trust, the engine of their business, was intact. The problem was headline noise, not fundamental failure. The business was being sold for half price because of a temporary, sensational headline. This is the point where the amateur buys a tiny, safe position just to say they participated. I did the opposite. I committed approximately 40% of my partnership's total net worth to American Express. Ponder the weight of that decision. 40%. This was terrifying, a defining risk. It was the largest single investment I had ever made. Had I been wrong, it would have been devastating for my partners, my reputation, and my career. This demonstrates the true professional's approach. Reduce risk through intense, concentrated knowledge, and then bet heavily where you have an overwhelming analytical advantage. The greatest cost of diversification is the erosion of your own discipline. When you own a scattered portfolio of 50 or 100 stocks, you are mentally fragmented. You are incentivized to follow the daily news cycle, which is chaos, instead of the long-term business cycle, which is truth. Concentration, conversely, forces you to think like a true owner, to read the annual reports, to visit the factories, to internalize the competitive advantage. You are forced to be exactly right about a few essential things, instead of vaguely right about many. That single, courageous, and concentrated bet on American Express became one of our most profitable investments, netting hundreds of millions. It proves the theorem. One good decision is worth 1,000 average ones. True wealth is built on focused conviction, not scattered fear. You must cultivate the knowledge to concentrate and the courage to act decisively on that knowledge. If the first rule requires you to concentrate your capital, the second rule demands that you concentrate your calm. Successful investing requires a temperament that is, in my view, far more important than a high IQ. A genius-level IQ is utterly useless if you have an emotional temperament that causes you to panic at the first sign of trouble. This temperament is tested when the market begins to behave irrationally. I often use the metaphor I learned from my great teacher, Ben Graham, which describes the market's true nature. I call the market Mr. Market. Imagine him as your silent, pathologically manic-depressive business partner who knocks on your door every single day. Some days he's ecstatic, offering you absurdly high prices for your share of the business, convinced tomorrow will be perfect. Other days he's suicidal, convinced the world is ending, and begs you to sell him your share for pennies on the dollar. The great tragic paradox is that most investors treat his clinical panic as the absolute truth. They are buying when he's euphoric and selling when he's despairing. They are allowing his external, clinical chaos to trigger their own internal, emotional fear. I treat Mr. Market not as an advisor, but as a servant. His sole purpose is to present me with an opportunity when his mood swings cause him to quote an absurd price. I use his madness to my advantage. His volatility is my greatest asset. Let me bring you to the darkest, most terrifying days of the modern financial system, the autumn of 2008. The world was not just volatile, it was collapsing. Lehman Brothers was gone. AIG, Bank of America, they were all teetering. You could literally hear the financial system screaming for immediate liquidity and confidence. The psychological horror of that time cannot be overstated. The question on everyone's mind was not if the financial system would fail, but how far it would fall into the abyss before intervention. I was sitting in Omaha, and the phone was ringing constantly. The voices on the other end were senior executives, titans of industry, men who had managed billions, and they were frankly terrified. Their fear was justified by the immediate liquidity crisis, but it was also financially blinding because they completely lost sight of the long-term franchise value of their own banks. I looked past the headlines. Was America going to stop needing basic banking? Was the country going to stop buying insurance? The long-term fundamental franchises of American business were intact. The stock price was not. The only problem was immediate liquidity and a complete collapse of confidence. That is where I thrive. It was during this period of maximum, paralyzing fear that I decided to act. The target was Goldman Sachs. They had a powerful, enduring brand, and they were desperate for a stamp of credibility and immediate capital, and they needed it that instant, which gave me immense leverage. I invested $5 billion in Goldman Sachs. But here is the critical detail, the paradox of fear. I did not buy common stock like everyone else. I demanded two things, both derived directly from their moment of desperation. First, perpetual preferred stock with a 10% annual dividend. This was non-negotiable. That meant Goldman had to pay $500 million a year to me, guaranteed, every year, before anyone else, before common shareholders, before executives, before bonuses got paid. This created a virtually risk-free, guaranteed income stream purchased during a moment of maximum systemic risk. Second, warrants the right to buy $5 billion more in common stock later at a heavily discounted price of $115 per share. These warrants were pure upside. They cost me nothing and allowed me to participate in the ultimate recovery of the common stock without taking the full initial risk. The paradox? The market's extreme fear gave me extreme leverage. They were so panicked, they accepted punitive, unheard-of terms. My ability to remain perfectly calm in the face of universal terror, my singular temperament, gave me the power to demand extraordinary, virtually guaranteed compensation. Volatility is not risk. Volatility is opportunity. Risk, as my mentor Ben Graham taught me, is the probability of a permanent loss of capital, not the fluctuation of a market price. A low price, provided the underlying business is sound, actually reduces risk. You must cultivate the discipline to view your portfolio not as a daily public opinion poll, but as a reflection of ownership in real businesses. When the price of an asset you understand falls, your true owner instinct should be to ask, "Can I buy more of this great thing on sale? Is Mr. Market throwing a fantastic bargain at me?" Not, "Should I sell before it goes to zero?" Your success will ultimately be determined not by the complexity of the formulas you use, but by the simplicity of your temperament and your refusal to let Mr. Market's madness infect your mind. That is paradox number 2. If the first 2 rules demand courage and calm, this third rule demands the most difficult virtue of all, humility. In an investment world that worships complexity, that values intricate derivative models, high-frequency trading, and cryptic acronyms, my greatest source of wealth has been my capacity for radical, almost boring, simplicity. This is the concept of the circle of competence. Most people believe the smarter you are, the larger your circle of competence must be. I disagree entirely. I believe the smarter you are, the more precise the boundary of your circle must be. Knowing what you don't know, and staying rigorously within the safe harbor of what you do know, is a discipline far more valuable than raw intellect. It is the boundary that defines the professional, separating them from the gambler. I only operate within those boundaries the businesses I can truly understand. If I cannot explain how the company makes money, detailing its competitive advantage, its long-term moat, and its value proposition to a smart 12-year-old in 3 minutes, I walk away. That rejection, that simple, silent no, is the most valuable tool in my arsenal. It prevents you from committing the cardinal sin of finance, believing your ego-driven curiosity is equivalent to knowledge. I have often been called ignorant, even a dinosaur, for this discipline. When the dot-com boom hit in the late 1990 seconds, the financial press and even my own partners were questioning my intelligence and relevance. They were getting rich on companies that had no earnings, only clicks and eyeballs, businesses that defied all traditional valuation metrics, operating on the fantasy that the rules of economic gravitation had been permanently repealed. I was sticking to Coca-Cola, Gillette, and Geico insurance businesses that had been around for decades and sold products people needed, regardless of internet speed. The pressure to conform, to chase the trend, was enormous. The fear of missing out, FOMO, is one of the most powerful and destructive psychological forces on Wall Street. It is a contagion that blinds intellect and destroys capital. But I maintained the discipline. I asked myself a simple, brutal question. Do I understand the long-term, enduring competitive economics of this new technology? The answer was clear. No. I didn't understand which of the thousands of dot-com companies would survive the shakeout. I didn't understand the long-term proprietary competitive advantage of building a website. So, what did I do? I did nothing. I sat on my hands and waited. The costliest mistake I didn't make. The paradox here is profound. The most valuable mistakes I have ever made are the ones I didn't commit. Yes, I missed out on some enormous early gains from companies that eventually became giants, like Amazon and Google. That is the cost of omission. The market will always punish you for not acting on a brilliant idea. But the cost of omission is utterly trivial compared to the cost of commission, losing all your capital because you let ego or fear pull you outside your circle, chasing something you couldn't fundamentally value. When the bubble burst in 2000, those complex, sophisticated tech companies collapsed, often taking investor capital down with them to zero. The money I missed was money I saved because I was operating in reality, not fantasy. I preferred a predictable return in a familiar business to a sensational loss in a mysterious one. The discipline of focus. You must become comfortable with the fact that the vast majority of the world is outside your competence. Your job is not to find 1,000 good businesses. Your job is to find a handful of exceptional businesses and stick with them for decades. Simplify your life, simplify your investing, and simplify your mind. That simplification is not just a tactical choice, it is a strategic freedom. It frees up the mental capacity to concentrate calmly on the few great things you truly understand. That is paradox number 3.
The journey into the oracle's mind is complete. The whispers of the market fall silent, and what remains is clarity. We have seen that extraordinary wealth is not built on complexity or noise, but on the ruthless application of 3 counterintuitive truths: simplicity, temperament, and the courage to stand alone when the crowd runs the other way. But this is only the beginning. The ledger of the oracle is vast. There are more mental models, more strategies, and more lessons buried in his decades of quiet decisions. We have only scratched the surface of what it means to be a true capital allocator, and we will continue to decode this mind, layer by layer. If you are ready to separate yourself from the noise, if you are ready to play the long game, subscribe. Join the ascent. This is Alpha Thought.